Stop making the problem worse. How much longer do you want to stay in the losing game before the market completely collapses? Look, the experts tell you stay the course and that corrections are normal, which is great advice if you want to lose money over the next 4 months and really probably the next 26 months. You don't have to invest in the stock market to get ahead. Now more than ever, it's time to be smart. Stop panicking and protect yourself before you lose a huge chunk of your investments. Almost all articles written about the financial markets are telling the same story to investors. Stay the course. You're in it for the long haul. If you're young, you have time to recover. Don't panic. Blah, blah, blah. I was reading an article that had this terrible advice and quotes from financial advisors in it. Here's the first quote. Stay calm. Corrections are normal. Really, these are normal? Wise investors do not move with the herds. Your investing strategy should not change. That was Michelle Perry Higgins. Really? Is that good advice? Or is this really advice at all? I'll show you why this is a terrible idea and what to do about it. But let me just show you some other things. Roger Ma, another financial advisor, says, keep focused not on external events, but your financial goals and when you need to accomplish them. Does the market give a shit about your goals? Does it? This seems like advocating taking no responsibility and ignoring what's going on. Wow. I mean, kind of sounds narcissistic to a certain degree, if you know what I'm saying. Yeah, these were written before trading was suspended a third time to prevent a market free fall. Let me quote Roger Ma again. He also wanted people to ask what they need to do to achieve their retirement goals. How about not lose 10% in a week or 7% in a day? You know, he also said that someone who is 20 has 40 or 50 years to retirement to ride out the ups and downs. This is dangerous advice that will lead to more risk, less return, and is a huge part of the problem. My advice has been the opposite for quite some time. For example, one of Wealth Factory's clients, Justin, gave me permission to share his story of having trailing stop losses. Now, we have all sorts of investment advisors that work in the Wealth Factory accredited network. And so they helped him put a stop loss, okay, a trailing stop loss. And what that does, and this is exactly what he said, I had all of my triggers set to 15%. So our advice is, at what point when the market goes down do you start to panic? At what point when the market goes down does your mindset start to follow? So he put 15% trailing stops, and they all activated, of course. He put, of course, haha, which really saved my ass. I'm quoting him. All my triggers activated between March 9th and 12th. Okay, he said, since my position sold, the Dow and S&P are both down an additional 11 to 12% overall at the time he emailed me. That's what he believes, okay? But he said, that's just in the market in general. Here's what he said. Some of his positions would have absolutely collapsed thanks to the coronavirus. For instance, his Tesla stock sold at $652 per share, and it's currently sitting at $465. He said his Shopify shares sold at $422, and they were currently sitting at $334. He said, I mean, I can go on and on with examples, man. It would have been a bloodbath without the trailing stops. Visa, Apple, Exxon, Chevron, etc. He said he had grabbed quite a few positions. All right, so let's break this down for you. Number one, thinking you can recover from losses doesn't account for companies that go under, right? Or for time value of money, which is also called opportunity cost. Let me say what that is. If you lose, you miss out on the time of that growth, and even a small loss, right? A small amount can add up to a bunch due to what it would have become. Okay, more on that in a bit. Ultimately, this type of ignorance must be accounted for, or you're going to take unnecessary risk, and those losses are compounded over time. Let me illustrate this, okay? Point one, let's go through market fluctuations. The first financial services firm I ever encountered convinced me to put my money in the stock market. I was 18 years old at the time. One illustration I was given showed a continuous 12% annual return, which they said was conservative. Now, why in the hell did they do this 12%? Because they claimed in 1998 that the stock market had averaged 12% since 1929, okay? Now, they were really about this you're in it for the long haul myth. Why that's a myth is, well, let's illustrate it. They showed me ending up with a fat nest egg at retirement age with a relatively low monthly investment of like $70 a month. The company also showed me what it would end up with if I had a continuous 18% rate of return, which is illegal, by the way. But because in the 90s, people thought the market was just always going to go up, they thought it would be fine. Now, in 2020, this seems absolutely ridiculous. But at the time, the 90s had inflated everyone's expectations. As an 18-year-old, I didn't know any better. They had to show me that on a separate calculator to show 18% because the software that the company put out wouldn't show those illustrations, right? The industry actually has laws to prevent financial services firms from legally illustrating more than the hypothetical 12% annual return, which is still ridiculous and inflated. Because when people look at the 90s, okay, the 90s, I get why they thought that. But if we look at from 2000 until, before the downturn of 2020, it's been more like 6% appreciation. So aside from the illegal tactics, their approach was fundamentally flawed. Financial service companies overlook that if we insert just one negative 12% annual return into the equation, in the time frame of that investment, the entire computation is thrown off literally by hundreds of thousands of dollars. It gets even worse when we replace that continuous 12% with the actual historical performance of the stock market. I'm going to do all this for you, okay? So why do retirement planners fail to consider and illustrate the possibility of negative returns? Well, the answer is twofold. First, most of them were not trained to incorporate negative returns into their calculations and may not realize how dramatic the effects can be. Second, even the ones who do realize this concept, well, they don't want to lose a sale by showing dismal numbers. Optimism, even unrealistic optimism, brings in more customers, all right? So because most of us labor under false information and all these financial myths, we get excited about the positive numbers and tend to think these calculations actually represent reality. So let's look at the numbers. In my book, Killing Sacred Cows, which I'll make sure you get a copy of, no charge, on page 74, I actually put together a chart. Now, this notion of, Roger Ma saying, look, if you're 20, you've got 40, 50 years before retirement, so you've got time. He's not taking into account what's called opportunity cost. If we insert one negative 12% annual return over a 30-year period, the entire forecast is thrown off by so much money. So, Roger, good luck with planning on retirement needs in that scenario. So let's use $100,000, and you can follow along with interest calculators or future value calculators. I downloaded one for free on my phone to kind of validate this that was in the book. If you had $100,000 at 12% over 30 years with no tax and no fees, it grows to $2,996,000. That's pretty cool. That sounds pretty exciting. But what if you had a 12% loss in year 10 instead of a 12% gain? It turns out that you only end up with $2,354,000. Now that's still a good amount of money, but that one negative year was a $642,000 loss. Yeah. $642,000 less. Now, let's use the actual return of the S&P 500 after 3 down years from 2000 to 2003, but we're including the best decade ever of the 90s. With that, the money ends up being more like $1,250,000. That's quite a bit different than $2,996,000, right? It's more than 50% off course. Look, here's the big point here. It doesn't matter if you lost that 12% in year 1, year 10, year 15, or year 30, if we're talking about a lump sum $100,000 investment, all of the time it still has a $642,000 impact. You may be asking why? Well, sure, in the first year, you'd only lose $12,000, right? That doesn't seem so bad. But now let's take $88,000 and run it at 12% for 29 years. $88,000 only grows to $2,354,000 because you don't have the gains on the $12,000 over that 29 years. That's crazy. So it doesn't matter if it's year 1, year 10, year 15, or year 30 because of something called opportunity cost and compound interest. There's compounded costs or compounded effects to the losses. So the second piece here, are we more committed to emotions or economics? See, if the market goes down and your mindset follows, well, now it's time to reconsider a few things. Did you do what Justin did and have a trailing stop loss on your account so you don't have to rely on a broker or say, I guess I'll just ride this out because the only way you lose is when you cash out? Well, how do you feel when you're not in control of the outcome of your investment income? I don't like it. I don't want to put my hopes and dreams on a market I don't control. Do you know why the market will go up or why it will go down? Do you know what your exit strategy is? You're your greatest asset. So if this is causing you stress, it's going to make you more vulnerable to getting sick, unfortunately. So the question is, are you focused on the solution or stuck in the problem? All right, the third piece. What can you do to improve your finances right now? What can you do to get guaranteed returns? Now, there's not guaranteed returns in the stock market. I also find it very interesting. Like when people say, oh, future, return or past returns are not an indicator of future results. I kind of feel like if you know much about football, I feel like Bill Belichick and the New England Patriots, they get rid of players who are no longer functional. But the Washington Redskins pick up those bad stocks or bad players and go, we'll overpay for them. That's what people are doing right now, thinking the market's low and that they're buying on sale. It's not on sale yet. It's not even close. There's still more to go. So what can you do to improve your finances? Let's talk about that. Refinance. Interest rates are low. Businesses impacted can get longer loans with greater rates from the SBA. Might be difficult, but they're now doing 30-year loans at 2.75 to 3.5% interest. That's really cheap. It's time for you to get access to cash, even if you don't need it immediately, so you can be prepared for worst case scenarios where this might go on longer than expected. I would start considering cashflowbanking.com over the stock market. Cashflow banking from the last 20 years for me has done 5.32%. The stock market has done around 6%, but I'm not losing money right now. And we're not including the negative 2020. So now my cash flow banking accounts, without the risk, without the stress, are outperforming the stock market. Less volatility with a similar net return. Plus, I have access to that cash when everything's on sale down the road to capitalize and buy. Plus, there's tax benefits without locking your money away, like retirement plans. Go to cashflowbanking.com to learn more. You can build up cash to buy in the near future. That's going to be a critical piece. This may not be possible for everyone if you're already in cash crunches. But if it is, look, there's still going to be plenty of deals down the road if you could build up liquidity. But if you think now's the deal, but you're not sure, don't speculate. Too many people are calling and texting and asking if now is the time to buy. If you have to ask me, the answer is pretty simple. It's not. You don't know. Now's the time to focus on cash flow, on economic independence more than ever. Economic independence where you're focused on cash flow and assets that help support your income. It's time to protect your assets. It's time to build up your reserves. The next piece. It's time to develop your investment philosophy. Maybe even reconsider everything that you're doing. Discover your investor DNA, which is your core values, your core competencies and where you have real knowledge, your core drivers and where you want to pay your attention. It is time to focus instead of diversify. Diversification is diversification in this type of market. It just means everything's getting a haircut. Everything's losing rather than just, a few things. But what if you focused on real deals, things that you knew and understand? Maybe you could buy a business that's at a deep discount. Not maybe in the stock market, maybe a private business. Maybe you wait for a while and you're a real estate investor and you're going to see more deals pop up as cash flows top. But look, I'd be careful. We saw Carl Icahn just shorted the commercial real estate market, which means he thinks it's going to go down. You've got to determine what a good investment is for you and what a bad investment is for you. And if you don't know, stay safe, stay liquid, pay off loans, build up cash flow. It's time to create a vision beyond this crisis. It's time to focus on cash flow again that far too many people have neglected. It's time to develop ways to increase your skill sets. Maybe it's time to learn marketing. Maybe read, watch, and learn, right? What you can do to monetize your skills, right? Find the things that motivate you while the stakes are higher than normal and traveling is limited because you have more time at home. Grab the mega kit, wealthfactory.com/mega kit. Text 44222 if that's easier and put wealthier in the subject line. Why? Because there's Killing Sacred Cows, my book, so you can help navigate the financial myths that are going to be everywhere during these times, where you can learn about what would the Rockefellers do so you don't have to participate in the downside. And then the next piece is it's time to learn from the big mistakes. Do you have enough liquidity so that you have staying power? See, saving and investing are two very different things. Investing locks money away. It's volatile. It's hopefully earning returns, but maybe not in this market. Saving is available. And when you have enough savings, you have staying power. You can have a peace of mind fund, an war chest, so you can handle these kind of crazy, erratic times. Maybe it's time to stop funding your retirement accounts and take care of your liquidity. The reality, it's time to stop making the problem worse. How much longer do you want to stay in a losing game before the market collapses? The experts tell you to stay the course and that corrections are normal, which is great advice if you want to lose money for the next 4 months. The investing advice from people that make their money selling the stock market may not be in your best interest, and it's time to take back control of your money. Now, you have the knowledge to transform your thoughts into profit, protect yourself from the downside, build more cash flow, and see profits instead of watching your money dissolve. It's time to build the life you love. If you're looking for more on this topic, check out my video on the absolute best investments. You'll learn why you should avoid risky stocks and what the one thing you can bank on is. I'll see you there.